Hello and welcome back. My name is Josh, and today I wanted to give a bit of an introduction to stocks and investing and just give my thoughts on if you are new to investing. So, obviously, I guess just to set some context, in the last year or so, we've seen extraordinary gains. This is a chart of the S&P 500, and we can see over the last 1 year, we've seen 32% gains. Typically, stock markets go up about 5 to 10% a year. It actually averages about 7. And if we go back in time, you can see, over the last 5 years, it's up 117%, which is very good. If you actually do 117, let's go 1.17 to the power of zero point 0.2 is how you get a compound annual. Oh, sorry, it's 2.17 because it's gone up. Uh, you get it's at returned about 17% per year, the stock market over the last 5 years. That's again extraordinary. Again, typically you see about 5 to 10%. If we go back even further, though, we can see there were strong stretches, between 1999, let's go here, and 2011. So that's 12 years. The total market went up 29% over these 12 years. Again, that's less than it went up in the last 1 year. So just to set some context, we've seen an extraordinary run up. You can see here, ending in the Great Recession, or beginning, I guess, in the Great Recession till now, we've seen an insane growth in the stock market, 468% up. So if we go 5, 7, 8, over how many years is that? 12? 5.78 divided by 1 over 13 years, 12 years actually. So it's averaged 15.7% over those last 12 years. That is really strong. So one, just to set expectations, you very well might see poor returns moving forwards. We have had it very good in the last little bit. So, don't be surprised if we do see sometimes like this where you see, this is a 40% drawdown. This was the stock bubble, tech bubble. Then you see here, this is the financial crisis, 50% drawdown. It would go even farther back, 87. I think there was a pretty big drawdown here. 23, not as bad, but there have been drawdowns before, and obviously you can see in the last, there was a massive drawdown during, this is COVID. It was 24%, but it quickly bounced back. How long before you were back at it? It was about 6, 7 months. So, I do think that governments don't want to see the stock market drop. So I think there will be more pressure for federal governments and governments around the world to pump money into the system when the markets go down. So I don't think you'll see markets go down as quickly. But again, I want to set expectations that we've had it very good. So don't expect every year to be like that. That's the first thing. Second, this extraordinary run up in stocks, especially ones like, again, I'm a big Tesla fan, huge fan. I've been a holder for a while, but this is an insane run up. You look at 2 years up 8, from, this is split adjusted. They split their stock, but from $50 to 1,222. This is, you don't see this often. That's why Tesla's in the news so much, is because it really is an extraordinary story. And that is, between it being talked about on CNBC and YouTube and Facebook. A lot of people know people that have made a lot of money on Tesla. And so it gets people excited about it. And so people are very excited by the stock market, more so than they've ever been. But in all seriousness, if you are a serious investor, or sorry, not if you're a serious investor, if you're really just trying to get into the market, the best way is not to go chasing gains in Tesla and AMD, GameStop, Facebook, Google. You should be looking at these, but this should not be a core part of your position. Unfortunately, the honest truth is, if you're really interested in investing in the stock market, the best option is to just buy a low-cost ETF. There could be S&P 500 ETFs. I mentioned the other day my favorite, MGK. I'm a big believer in this one. It only invests in the top 100 companies instead of the S&P 500. It's basically sorry, and it has to instead of the S&P 500, it's basically the S&P 100. Because the biggest gainers are Apple, Facebook, Google, Netflix, Tesla. I think these big companies have a huge market share, and so they've grown far faster than the companies that are lower down. Uh, so I'm a big believer in just investing in a low cost ETF. But you won't see much of that on Facebook or YouTube. Why? Because if I told you, hey, you know how you get rich slowly? If you just put money away every month in an ETF, um, you'll do well in 30 years. You can't produce content about that every week. It's true. Unfortunately, that's why most people aren't talking about that. Most people are talking about stocks because every day there's stocks that go up and down and move, and that gets people's attention and keeps people watching. Now, obviously, I also do invest in individual stocks, and I do think it is important to invest in individual stocks. But I also want to set the expectation that we've had an extraordinary run up, so stocks might they might pull back, and two, I don't think you should have too much of your portfolio in individual stocks, especially those that are highly volatile, like a Tesla. Could you make a ton of money? Of course. But I really think, and I practice what I preach, I still have most of my money, or a large portion of my money, in low cost ETFs that I think will continue to grow in the long term. And that's the unsexy thing to do. But I really think that is, if you're just a beginner and trying to get in, I think one, you want to give yourself a foundation for growth. And I think that this is a good way of doing it. I then think there's a strategy called the barbell strategy. Basically means you should have two different buckets of investments. I think you should do this with a lot of your money. I think with good, maybe 50%, you should invest in a low cost ETF and just set it and forget it. Because in 30 years, you really want to know that you're going to be able to retire or buy a house in a couple years if you want. With the other 50%, though, if you're really interested in learning about how you can make a lot of money in the stock market, which again I am, and I've done very well. But shout out to a lot of uh, other YouTube channels. I think I'll post a video here about some YouTube channels I'm a really big fan of. Um, but if you're really interested, then do with the other 50%. Play around with it. Invest in Google. Invest in Tesla. Start doing your own research. Why are you investing in Google? What drives their share price up? Is it revenue growth? Why? And if it is, like, why do you think Tesla's seen extraordinary revenue growth? Why do you think that's going to continue? Um, there's a lot of things that you can do to. To me, there's a couple ways you can look at investing. Again, you always got to look at valuation, but I've said this before. You can plug in any numbers and make any uh, stock look good. This is Sonos here. If you think they're going to grow 28%, then 9%, then 14%, then 12%, then 6%, whatever, that's what they had. This looks like a great stock. If you think they're going to grow basically nothing over the next couple years, it doesn't look like a good investment. So you have to have a story behind it and say, why do I think Sonos, or any stock in this case, is going to grow? Well, with work from home, people are going to spend more time at home, and people don't want to go to the movies, so therefore they want to spend more on their home entertainment system. So I think that's going to drive growth. Oh, you know, um, more people around the world are getting into the middle class, and they're going to grow the market for high-end stereo equipment. There's these stories that can explain why you see revenue growth going up or margins going up, and you have to have a story, and that story has to help back up the numbers. So again, to me, this is what investing is about. It's about trying to understand a company, and from there you can then, if you really understand the company and the market, that's where you can have your most edge. So again, I strongly encourage people not to think of stocks as lines that go up and down. Think about it as a business. So you want to invest in businesses you understand. If you are you work at a Chipotle and you know they're coming out with a new menu item that people are going to love, or your friend had it and he got totally sick and you think it might cause a drop in the stock price, like, do it based on that, put your money where your mouth is, and use your knowledge as best you can. So if you are a nurse and you know about it, you've seen a drug that patients are using that has really helped them, maybe look more into that. So that's what I really want to push is one, remember these are companies. Two, we've had an extraordinary run up, so set expectations because you know people on YouTube and Facebook, they just want to go rah 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 and pump things up. Not everything's going to be up. There's going to be ups and downs, but I'm in it for the long run, and I understand that there's going to be ups and downs. I've had some losses recently. Zillow got hit hard, Peloton got hit hard. Zillow, I'm still not sure if I buy in because of I think that fundamentally changed the business. But with Peloton, it has changed my expectations a little, but I still believe in the future, that the story that I built around Peloton, which is I see the future being more about connected fitness and Peloton being a major player there. And so my thesis is not broken. So again, you always have to start with a story and then put numbers to that story. And if it looks like a good investment, believe in yourself. To me, if you still believe in the thesis and the stock price is down, you're getting the stock on discount, and that's really when you make the best returns. Back to the S&P 500. If you invested here, you didn't do too well. It took you a while till you broke even. If you invest at the bottom when it's on discount, you did a hell of a lot better. So, um, this is just I wanted to set expectations and tell you a bit more about how I see the stock market, and if you're a beginner, what I think you should do. Again, this is opinions, not advice, but I really think people, if you're a very beginner, you should be one, investing in safer things just so you have something saved. And if you do want to invest in stocks, especially riskier stocks, make sure you understand why you're investing in it. Not just, hey, I saw some guy on YouTube. Do research, understand the business, understand the company. And when you do that, then you're going to have a much higher hit rate. You're much more likely to be successful if you're investing in things where you understand the thesis behind it. So, thanks so much for watching. My name is Josh. Let me know your thoughts below. What are you invested in? Let me know if there's something you want me to analyze. I'm happy to analyze stocks that you recommend. So just make a note in the comment section below, and I will analyze it. Thanks so much, and talk to you next time. Cheers.